I think now we'll move on to Basel III, which is obviously the core concern at the moment that's affecting everyone. And Eric, maybe starting with you, you mentioned Toronto meeting. Are we any the wiser now about the approach that's going to be taken? Is it going to be a case of, do more but do it slowly, or try and do a bit less and bring it in a bit quicker? Are we any the wiser, or is it still very much up in the air?
I believe it's very much still up in the air, to be honest. As I was saying earlier, I don't think we have learned much through what was disclosed after Toronto. We expect some clarity in the course of the summer, but really probably more likely in the fall. And I think we have all received some guidance on some pockets, some areas of the initial Basel III proposal that David was referring to earlier. And I think we are getting more clarity, especially on the liquidity front, that hopefully it's not going to be as strict as anticipated. I think some also of the proposals, some other proposals have been watered down. We are also getting some guidance on the timetable of implementation, and I think there seems to be a general consensus that it's going to be longer than expected. Now, what exactly does that mean? Frankly, I don't think we learned a lot in the last few weeks that was very different from what we already knew before the Toronto meetings.
And obviously, the liquidity aspect has been mentioned as one that's causing key concern. In terms of the other responses, whatever it was, 270 different institutions that responded to the proposals. Where were the other areas that are real kind of pressure points for the banks that are causing most concern?
I didn't read all of the 270 proposals put forward or counter proposals put forward, but I do know that our research people did actually go through them. I think the most cited or referenced objection was against the leverage ratio, which was deemed as being way either too blunt or not taking into account any form of risk weighting. Anyway, the leverage ratio, as it was initially proposed, has been raised, I think, more often than any other of the proposed measures. That said, I think the list is very long of measures that have been individually proposed for amendment, very often to address very specific either nationalistic issues or to take into account very specific taxation of a given country. I'm sure that, for example, minority interest, the treatment of minority interest has been raised by a number of parties for whom minority interest is a fundamental source of capital. So without being name specific, I think we can all guess who they may be.
Sort of groups of banks in particular where the parent,
exactly.
The head group is raising tier 2 and putting tier 1 into subsidiaries or whatever.
Exactly, and so almost every single measure has been raised by one party or another. But I think the one that I've seen raised the most, I would say, generally across the board, would have been the leverage ratio.
It almost felt like it was sabotage, that, because it was so out there that no one ever thought it could possibly come into being. I mean, everyone said it's not possible, not feasible. I remember when it was the very first time, just before it was announced, the rumour was what it would be. It just felt inconceivable that would ever be implementable. I felt that 270 was interesting. First of all, I thought more people would comment. Secondly, I thought that the cohesion of some of the responses showed that the industry had got together and formed little clusters of self-help groups. And thirdly, I think that equally the responses were very specific about those institutions too. These are very individual, idiosyncratic organisations where this change to deferred tax has this impact and is different there than it is down the street at seemingly similar looking institutions. And I think all the capital deductions from software through to pension deficit, etc., it really showed how difficult it is for the regulator to get a handle on such a diverse group of sheep.
Yeah, the 270 is an interesting number when you put it in the context of the 1,171 banks that did participate in the one-year repo that just expired. I think on the capital side, though, obviously the debate will be ongoing in terms of the deductions from capital. In terms of the capital instruments themselves, it strikes me that there is, acceptance that the quality of capital let alone the quantum of capital, is going to have to be greater than it was in the past. Now, whether we see some form of loss absorption in traditionally gone concern capital like lower tier 2, whether the further iteration of that will be, broader application of the bail-in concept, I think is work in progress. But there's no doubt the bar has been significantly raised for the industry in terms of what it takes to qualify as capital. And indeed, the focus, and we spend all our days now talking about core tier 1. We hardly used that phrase 3 years ago. It was all tier 1 and total capital ratio. And unfortunately, the raising of that bar is probably going to be too high for many institutions.
And on that question, obviously, of contingent capital, we've seen a couple of approaches. We've seen the Lloyd's approach last year. We've seen Rabobank this year, a slightly different structure. I mean, is this an instrument that's in search of a market and not finding one? Is it one that's going to be driven by sort of regulatory necessity that banks will want contingent capital cushions as opposed to having to raise yet more tier 1 if that alternative is sort of offered to them? I don't know whether any of the markets are.
As opposed to raising tier 1, I think the regulations, unless I'm mistaken, are still fairly clear that there is room for a layer of hybrid tier 1 on top of or separate from core tier 1, in the same way that there is room for tier 2, albeit with probably different features to ensure greater loss absorption potential on an ongoing basis. But then next to that, or and I'm not sure where exactly you layer it in, but certainly within somewhere in the capital structure, the suggestion has been made, I think quite vocally, even though it lacks detail for now, that there should be room for contingent capital to reduce so-called tail risk, or at least to deal with the tail risk if and when it appears. The next question is, well, at what level of cost does it become efficient for a particular institution to issue it? And I think for now, to be honest, the overriding question is, well, before I issue any of it, I'd like to know exactly what kind of treatment I'm going to get for it, which is probably why we've seen so few examples today.
And I mean, I guess the crucial question here perhaps also is how the banks are responding at this point. And we started off with this discussion of banks needing to think well ahead and make sure that that they're ready to access the market in whatever way they need to. Are banks a little bit in denial about Basel III, or are many banks already thinking about at some point in the future, I'm going to need a strategy to raise capital to meet Basel III requirements, and over what sort of timescale they want to do that? Is it better to do that sooner rather than kind of waiting until there's a rush?
No, I mean, I don't think there's any bank that's in denial. I think it's central to management concerns at this point. But as Eric put it well, one of the bizarre consequences of the December 2009 press release was it did in fact hinder recapitalisation, because people did not know what the treatment of the instruments they were going to issue was going to be. They didn't know whether they were going to be grandfathered or not. So while market conditions were actually pretty attractive in the first 4 months of the year, deals that would have happened didn't, because you need a lot of chutzpah to be able to do a deal if in a year's time it no longer qualifies as tier 1. I think I'm probably a little bit more optimistic about the outlook for contingent capital. I think regulators, perhaps with the exception of one key European regulators, seem to be quite open to it as a concept. And indeed, I think it will play a part, if only perhaps providing quality capital for those institutions where the cost of a straight core tier 1 instrument or even a hybrid tier 1 instrument is simply too high. So if we take both the precedent transactions, having a host instrument which is a must-pay, must-redeem deal, but has loss absorption with some kind of clearly defined trigger, but one which is sufficiently out of the money, that should be a competitive, at least tax-deductible alternative for many banks. And I think in that sense, it helps the politicians and the regulators, bridge the gap between ensuring, a sufficient quantum of capital and stability and integrity of bank balance sheets, but at the same time providing something which is cost-effective enough so that the cost of credit to the broader economy doesn't hinder growth.